let's just quickly then take a look at our learning objectives. So for the interest rate, this first section is really the interest rates. Theme 1 is interest rates. Bond valuation is theme 2. So regarding interest rates, you must be able to describe interest rate fundamentals and describe or discuss the term structure of interest rates and risk premiums. So there's quite a bit of theory regarding interest rates and their structure in this part of the learning unit. So in a way, this interest rate section is also one of the foundational aspects of the whole module, because that then goes together with time value of money, the concept of risk and return, and interest rates, which are also going to be built in everything else that we do. So we'll take a quick look at interest rates in a minute. And then bond valuation. So this is now where we really start applying our time value of money, interest rate theory, and risk and return theory into actual financial decisions and calculations. So bond valuation, we take a look at the financial instruments called bond, and as investors, how we would go about calculating what the value of a bond is, so that we know what the price of that bond should be, so that we can then decide whether to invest in that bond or not. And also the calculation for bond valuation also allows us to calculate what return, if we do purchase this particular bond or invest in this particular bond, it allows us to calculate what our return on that investment would be. And that's this last section here, yield to maturity. Okay, so in this section, we discuss the key inputs in the basic model, in other words, the financial model, the formula, and the key variables that make up the formula for calculating a bond valuation. And then we apply that valuation model, the formula, to bonds, so that we can then, and this is the part where we do the calculations with various different bonds and various different permutations of interest rate and number of years that we're going to own the bond, etc. Okay, and then this last one is then, instead of calculating the value of the bond, we are going to calculate the return that the bond will give us. Okay, so that is what is then covered in this particular section. So then we're just quickly going to go over a couple of slides on interest rates. So if you go to your textbook, if you've got your textbooks in front of you, just go here. If you go to, you'll see right from the beginning of the chapter, this is where the chapter starts with discussing interest rates. So on the set of slides, this first slide is really just a recap to remind you of what we covered in Learning Unit 3, the Risk and Return Learning Unit. Just again, the main concepts and the main learning objectives. So again, just to remind you, you should now have studied and know the definitions for risk and return, be able to describe risk averse, risk neutral, and risk seeking. Be able to use sensitivity analysis and probability analysis to discuss assessing the risk of a single asset, and then our standard deviation and coefficient of variation, those two formulas for measuring the risk of a single asset, as well as measuring the risk of a portfolio of assets. And then remember, we discussed the theoretical concepts of correlation and how we use that to diversify our investment portfolios. And we looked at the effect of international assets on the diversification of a portfolio. And then two very important theoretical concepts you must also be able to describe as then the difference between unsystematic risk in the marketplace and systematic risk. So this again is all to do with our investment portfolio, and it is making the assumption that our portfolio is made up of a collection of investments in different entities, different companies, in the form of shares that we own in those companies. And then lastly, we had a look at the capital asset pricing model, the CAPM formula. And again, we'll use the CAPM formula in later chapters also, because this is the formula that we can use to calculate what is an investor's required rate of return for a specific asset, given that particular asset's risk profile and the general return of the market at that point in time. Okay, so I hope that's jogged your memories. That was what we covered last week. These revision questions, those are the revision questions at the end of Learning Unit 3. So that was also just always very important. At the end of each learning unit in your textbook, you'll find that set of revision questions. And those are always excellent questions to go through and to cover in preparation for your tasks and exams. So then this is a discussion on interest rates, specifically interest rates first of all. And I'm not going to go through all of this theory in detail, because we just don't have, with only one hour session in the time for our Learning Unit 4, there isn't time. So in the section from the beginning of your Learning Unit 4, the introduction, and then you'll see we've got interest rates, the fundamentals, and then over the page, the real rate of interest, the nominal rate of interest, and then at the bottom of that page, we've got the Fisher formula. So all of this is stuff that you should cover yourself, read through. And none of this is difficult. It's mostly theoretical, but it is important foundational concepts and principles that you need to understand, so that you'll understand the rest of the calculations that you do. Okay, there's nothing on that page that I want to go over that you won't be able to cover on your own. Okay, so this is something that I want to just highlight. In questions that you get given in tests and exams, they will talk about interest rates. They will talk about the cost of borrowing. They will talk about the required rate of return. And I just wanted to highlight that all three of those terms are interchangeable and they mean the same thing. So if you are an investor and you are borrowing money, probably the most important thing you need to know is what is that investment going to cost you in terms of the interest that you will pay on that. So also remember, and this is, if you were borrowing money, the interest rate would be the interest rate that you would be paying. The cost of borrowing would be the cost to you of borrowing. And the required rate of return would be the required rate of return of the entity that you were borrowing the money from. But there is also the complete inverse or flip of this, and that is if you are the investor and you are earning the interest rates. Okay, so then that would be the interest rate that you were earning on your investment. The cost of borrowing would be your income. What income are you going to get from lending your money? And then your required rate of return would be also, as an investor, investing my money into somebody else's company or financial asset, what return, i.e. interest rate, do I require if I am going to invest in this particular asset? So always look at questions as well, and just make sure you understand from which side of the fence are you sitting. Are you the borrower or are you the lender? So when we talk about interest rates, they are made up these three main components: inflation, a risk premium, and the time value of money. So this is what is taken into account in determining what interest rate is going to be charged or what interest rate is going to be paid on a particular investment. So just to clarify the concepts, the difference between the nominal rate of interest and the real rate of interest. The real rate of interest is our interest rate before we have added inflation. So the real interest rate plus inflation rate is what how we get the nominal interest rate. And the nominal interest rate is the quoted interest rate, and that's the interest rate that we deal with on a daily basis. For instance, the interest rate that you'll get if you've got money saved up in a money market account or in a savings account. That interest rate is that the bank quotes you is a nominal interest rate. So that's just it expressed as a formula. R is the real rate of interest, H is inflation, and I represents the nominal rate of return or nominal rate of interest. So particularly for the exam, because obviously that will be a closed book assessment, this Fisher formula is not on your formula sheet. So you should, you need to memorize this formula. And they have in the past several times included a short question where you've had to use the Fisher formula to then calculate just put that in the chat box, that's where you need to calculate either the nominal rate of interest, the real rate of interest, or the inflation rate. Because in questions like this, sometimes they'll give you the nominal rate and the inflation rate, and they'll say calculate the real rate. Or they'll give you the nominal rate and the real rate, and they'll say calculate the rate of inflation. So you just need to know what the basic formula is, substitute in whatever information they've given you, and then you'll be able to solve for the third missing variable. You have got these slides uploaded, so you will be able to go through these in your own terms. So the structure of interest rate and the yield curve, this is all very theoretical, so this you can go through in your own time. There's three theories of to explain the shape of the yield curve for interest: expectations theory, liquidity preference theory, and market segmentation theory. They do ask this in exams. In fact, in the June exam, the students were asked to explain the shape of the yield curve according to the liquidity preference theory. And I think that question was worth maybe 10 marks. I can't quite remember now. But they do ask these questions in the exams. Obviously, not so much probably likely in the task, because in the task, it's an open book. So they're more likely to give you questions that you've got to do a little bit of research for, or maybe some calculations. So that's expectations theory, that's liquidity preference theory, and that slide is the market segmentation theory. The last one, which is important, is the risk premium. So the interest formula that we looked at previously was just nominal rate I is equal to R, the real rate, plus H, which is inflation. But now we are going to add to that a risk premium. Remember, Learning Unit 3 was all about risk and return. So investors have to include a premium for risk. So if an investment is very risky, then in order for an investor to be tempted into investing into that project, they would want to be compensated by being paid a premium for that risk. So that would then serve to increase the nominal rate of interest. So then your nominal rate is made up of the real rate of interest plus inflation plus a risk premium as well. So that is also a very important aspect of interest rates. Okay, so make sure you read through that whole section in your textbook, and that you go through all the examples, that you understand it all, and that you memorize those formulas that you need to, and practice those little diagrams. If you the 3 interest rate curves on page 98, you can use those to understand that theory on the structure of interest rates and our 3 different theories. Okay, so that covers that whole first section of the Learning Unit 4, which is on interest rates. Nothing very difficult there, and you'll definitely be able to manage all of that on your own. So then the second part of the chapter is on bond valuation. So the learning objectives for our bond valuations are that we must be able to understand the key inputs. In other words, what variables do we have when we are calculating a bond valuation in the basic bond valuation model. So the bond valuation model is a formula, and the key inputs are the variables in our bond valuation formula. And then you must be able to apply that valuation model to bonds. So what they do there quite simply is they'll give us case studies or little scenarios of examples of bonds with differing terms, etc. And then with whatever information they've given us, we then have to calculate what that bond, the value of that bond would be. Sometimes they also ask us to calculate the return of the bond. So this is just again to remind you of what was important in Learning Unit 4 so far, those concepts that we had a quick look at now about the interest rates. And then here's our discussion on the bonds. So first of all, what is a bond? Does anybody know, can anybody here give me a description? What is your understanding when we say a bond? So this is a bond, when we're talking about a bond as a financial instrument, okay, that type of a bond. So what is your understanding of a bond? If someone asked you to give a definition of in your own words or just to describe a bond, what is your understanding? Does anybody have any idea at this point as to what a bond is? I'm sure you've heard of bonds being discussed in terms of investments, but what is a bond? What makes it a bond that is different to other types of investments? A mortgage loan is an example of a bond, but it's not an example of a bond as a financial instrument, although I suppose it could be. But in terms of the bonds that we're going to value in this chapter, it's not so much a mortgage loan, although we do call a mortgage loan, it is called a mortgage bond, and we call it a bond because the bank takes the property that they are loaning the money to purchase, they take that property in bond. In other words, they contract that property to them, to the bank, until the loan is paid off. So that's a slightly different version of a bond, a different type of financial instrument. So if you have a look here on the slide, but it's very good, it's very well done that you remembered that that it is called a mortgage bond, because that shows that you do understand those terms. So that's good. But the kind of bond that we're talking about here in this chapter is going to be also a contract. So a mortgage bond it's a contract that you draw up between yourselves and the bank. And in this case, the bonds that we're looking at is a contract that's going to be drawn up between the investor and the company that they are investing in. Okay. So the actual contract itself is the bond. And what happens here is that a company needs to raise long-term funding for some or other project or expansion or something that they want to do, and they are needing to raise funds. So they don't want to go to a bank and borrow a large amount of money in the form of a loan from a bank, and they don't want to sell new shares in their company and dilute the ownership of the company. So another option they've got in order to raise money for use in the company is to issue bonds. So we say that the company issues bonds. So a bond is a form of a loan instrument, but in this case, the company wants the loan and the investor is going to lend the money to the company. So they draw up this contract between them. And what this contract specifies is how long the money is going to be borrowed for. So in other words, it's what we call the term to maturity. In other words, from the date the bond is issued until the date that the company will pay the money back to the investor, how long that's going to be. It also specifies what interest rate the investor will be paid, and that in terms of a bond is called a coupon rate. And then each bond has got a very specific, what we call a par value. So it's almost like if you've got a 200 Rand note and the amount 200 is printed on that note, that would be the par value of that note is 200 Rand. So each bond has got a par value. So it could be 1,000 Rand, it could be 10,000 Rand. It could even be 1,000,000 Rand for one bond. It all depends on how the company has structured that particular bond issue. Okay, so those are the three things that will be specified in a bond contract. What the coupon rate is, what interest rate the bond is going to be paying, how much the investor has to pay for one bond, and if they were buying it at par value, and for how long that bond was going to be issued for. So a bond is a loan for a specific length of time, and at the end of that specified length of time, the company pays the capital amount back to the investor, but during the lifetime of the bond, the investor receives that annual interest. Okay, so a fixed rate of interest, which we call a coupon rate, it's usually payable every 6 months, sometimes once a year. So this is in practice. They're considered a low risk investment. It's because it's pretty much a guaranteed investment. It's low risk. The year of maturity is the year in which the capital amount, the nominal value or the par value, is going to be repaid back to the lender. And then bonds can have a term to maturity of anything from between 5 to 30 years. Bonds are traded on securities exchanges. So in other words, like the Johannesburg Stock Exchange or securities exchanges, you would buy bonds through a broker, and investors can sell bonds to other investors. So just like you can buy and sell shares, you can buy and sell bonds as well on the in the capital markets. So usually when bonds are issued for the first time by the company that wants to raise the money, they will be issued at par value, okay, which is then that amount that's printed on the bond. But once we are, so say a bond for 30 years, it might be issued at par value in the beginning. But if the initial investor wants to sell that bond after 10 years to another investor, then that is when we do this bond valuation exercise to work out what should be the correct price that bond should change hands at, given the particular market conditions, required rate of return of the investor at that time, how many years are left to the maturity of that bond, and what is the coupon rate that that particular bond pays. So those are all the things we then take into account when we go and do that bond valuation calculation. Okay, so the learning objective said that we need to know what our key inputs are for a bond. And if you go and have a look at its section 4.4 in your textbooks, in my textbook it's on page 105, but it could be somewhere around there in your book, depending on how old your book or how new your book is. That is where the key inputs are discussed. So you must read that section and make sure that you understand it. And this is the section that then introduces us to the bond formula and explains how the formula works. And you have to understand this formula. This is the very important section of the chapter where before you even start trying to calculate bonds, you must make sure that you understand this part, the key inputs in the basic valuation model. So the key inputs are where we are applying the principle of time value of money in the valuation of a bond, and we're also linking risk and return to this bond valuation process. So we're taking all of these things into account, and these have all been built into the basic valuation model. So our three key inputs are the cash flows. So what cash flows are associated with the bond. The term means how many years are there to maturity from today when we are valuing the bond until the date that the bond expires or matures. And most importantly, at this time of valuation of the bond, what is the required rate of return of the investor? Okay, because if you've got a bond that's going to be in existence for 30 years, the required rate of return of investors over those 30 years will be changing constantly as inflation changes over time. And we also take in the time value of money into account. And what was the other thing? And also the risk associated with the market or this specific bond will change over time. So we need to reassess what that percentage required rate of return for the investor is each time we do a valuation for that bond. So the most important thing is that you don't confuse the coupon rate of the bond, which is fixed and printed on the bond. It's the fixed interest rate that the bond is going to pay the investor. That's called the coupon rate. Don't confuse that with the required rate of return of the investor. Okay, the required rate of return will be changeable over the life of the bond, depending on the specific investor and depending on market conditions. But the coupon rate is fixed for the entire life of the bond. So what are we talking about when we say the cash flows of a bond? So when a bond is initially issued for the first time, the cash will flow from the investor to the company because the investor will be purchasing the bond. We use the word purchasing, but really we're lending the money to the company. Okay, so the purchase price of the bond is the initial cash flow. So the direction of that cash flow is from the investor to the company. Okay, now the investor owns the bond. So for the rest of the life of the bond, the cash flow will now be the coupon rate. In other words, the annual interest paid to the investor by the company that issued the bond. So that will be, and that is calculated at whatever the par value of the bond is, and it's always calculated on the par value times the coupon rate. Okay, and that calculation and rand value is fixed. It doesn't change throughout the life of the bond because the par value doesn't change, the coupon rate doesn't change. So the direction of this cash flow is from the company to the investor, because the investor is now earning interest over the lifetime of the bond. And then right at the end of the life of the bond, at the end of the 30 years, the bond matures and the company pays the initial loan amount back to the investor. So I'm calling it the par value. The par value of the loan is returned to the investor at the end of the life of the bond. And the direction of that cash flow is also from the company to the investor. Okay, so initial cash flow from the investor to the company, the capital amount that you are lending the company. And then throughout the lifetime of the bond, the cash flow is the interest that is paid to the investor by the company. And at the end of the life of the bond, that capital amount that was initially paid to the company is now repaid back to the investor. So that is the pattern of the cash flows of a bond. So if you remember from your time value of money chapter, you remember the concept of, an annuity. Can anyone remember what an annuity is? Can you describe to me what would be the characteristics of an annuity? How would I recognize that a particular pattern of cash flows is an annuity? Can anybody remember? So to recognize an annuity, you are looking at a cash flow that is a regular do I want to use the word identical? I'll use the word identical. Okay, regular identical amount of money that is paid over a specific time period. Okay, that's the definition of an annuity. So remember, in the time value of money chapter, we learned to calculate the present value and the future value of an annuity. Okay, so the pattern of the cash flows of the interest that is paid on a bond, that is an example of an annuity, because every single year for the life of the bond, the investor will be receiving the exact same amount of money every year, which is that coupon rate. So when we are going to value a bond, we are going to calculate the present value of those interest payments. And we're going to use the present value of an annuity formula, exact same formula, to do that. Because we are doing exactly that, calculating the present value of an annuity. And then at the end of the lifetime of the bond, when the bond matures, the lump sum of the value of the bond, that capital amount, is then paid back to the investor. So that's an example of a lump sum payment. The maturity of the capital value of the bond. So we do a separate calculation to calculate the present value of a lump sum, to calculate what the present value of that final repayment of the bond will be. So our bond valuation, and we use the symbol B0 for bond at time zero. So time zero means the present. So in other words, the present value of a bond is equal to the present value of the annuity of the interest payments plus the present value of the lump sum maturity value. And that is the bond valuation calculation. So you already know the present value of an annuity formula from Learning Unit 2, and you already know the present value of a lump sum formula from Learning Unit 2. So now we're going to use those two formulas that we learned and put them together into one calculation in order to value the present value of our bond. And when we calculate the present value of the bond, that is saying this is what the bond is worth today, in other words, the present value of the bond. And then what the rand value we calculate, we then say that that is the price that should be paid for that bond. If we were going to buy or sell that bond today, what price should I sell it for if I'm the seller? And what price should I expect to pay for it if I'm going to purchase that bond from another investor? And that's the purpose of doing this valuation. Okay, so this is just telling you the same thing about we're using the present value of an annuity and the present value of a lump sum. So the bonds got two distinct cash flows, the periodic coupon payment. So that coupon payments are like an annuity because the valuation of the coupon payments is done using the annuity formula. And then the nominal value of the bond, which is payable at the maturity of the bond, and this is like a lump sum payment because it's valued using the present value formula for a lump sum. So if you just look at the formula for a bond in your textbooks, it looks super complicated, but if you break it down like this, then you understand exactly what we're doing, and then it's not so complicated at all. So these are the variables that we use in the bond formula, and you can find this on page 106 in that section headed the basic valuation model. And you'll see they've got the formula printed in the textbook, and they've got it neatly shown as well with a bracket showing that after the equal sign and before the plus sign, that part of the formula is the present value of an annuity formula, and we're going to use that to value the present value of the coupon payments. And then after the plus sign, where we've got the capital M multiplied by, that is our present value of a lump sum formula, and we're going to use that to calculate the present value of the maturity value of the bond. So B0 means the value of the bond at time zero, in other words, today or at the date of issue. PMT, we use the letters PMT for as like a abbreviation of payment to represent those periodic annuity coupon payments, i.e. the interest that we will be receiving each year. So the rand value of the interest we insert into the formula wherever we see PMT. R, small r, we use the required rate of return on the annuity for that. So R represents an interest rate, but specifically the required rate of return. Remember, we said there are three important inputs for the bond valuation, one of them being what is the required rate of return of the investor. So this is that percentage. Not to be confused with this percentage here that we use to calculate PMT. And then N, small n, is the number, the term of the bond expressed in years. So this N must always be from today, when I'm valuing the bond, how many years are there left until maturity? Sorry, I typed something wrong here. N is equal to the number of years left from the time of the valuation up to the maturity date. Students often get confused with that N, so just remember that. You may make sure you understand that it's from the time, the date I'm valuing the bond, how many years are left in the life of the bond. And then M, that capital M, is going to be the future value. In other words, the par value or that notional value, nominal value of the bond. In other words, that lump sum that I'm going to receive when the bond finally matures. Okay. So work through example 4.5 on page 6, because that is a simple example of where they give you a simple description, a little case study of a bond, and then they show you how we take each of those values that are mentioned in the little description of the bond, and they are then substituted into the formula. So make sure you look at example 4.5 and understand it thoroughly, where each of those amounts are coming from. So in other words, to be able to recognize for each of the variables in my bond formula, how will I recognize in my little case study which value belongs into which variable. And then also look at the end of, if you've got your textbooks, at the end of example 4.5, they've got the financial calculator method for a bond valuation, which obviously is will be quicker than using the formula and then calculating the formula out using maths. The bond valuation formula is on your formula sheet, by the way, so you wouldn't have to memorize that in the exam. And then if you have a look at the financial calculator inputs, you'll see that we've got N equals 5. So just if we go back here to the variables in our formula, so this N here would be what you would program into the N key of your financial calculator for the number of years. The IYR that you program in would be the required rate of return. That would be the small r. The PMT, they've got it in capitals, is exactly the same as this PMT that you put into the formula. That is the nominal value of the bond multiplied by the coupon rate of the bond. And then the future value, FV, that you program into the calculator is going to be the same value as this capital M, which is the future lump sum that we will receive on maturity of the bond. And it's a future value because we're going to receive that value at the end of the 10 years or the 20 years lifespan of the bond. So FV is what goes into the capital M. And then we, on your calculator, you would then comp PV, present value. So in that case, PV is the equivalent of B0 of the formula. So B0 is the present value of the bond according to the formula, and PV is the present value of the bond if you were using a financial calculator. So just use those financial calculator inputs will also help you to understand the formula if you have a look at the two together. Financial calculator inputs and where those variables match up with my formula variables. So use example 4.5 to practice that. Example 4.6 also explains a very important concept. So go through that one. And then example 4.7 is also another very important concept, which, oopsie, what did I do there? 4.7 shows us where the coupon rate, coupon rate, or the coupon is paid more than once per annum. So remember earlier on they said most bonds are paid the coupon is paid every 6 months. So there we need to adjust our bond formula. So where we've got R in the bond formula, we're going to put R over M. And where we've got N in the formula, we're going to use N times M, just like we did in Learning Unit 2 when we had a present or future value and the interest was going to compound more than once per annum. So that's exact same concept that we take in from Learning Unit 2. So that will be explained in example 4.7. And then your question 4.5 is also very NB for practicing. So use that to practice and make sure that you can see whether you can do it. And also it's going to help you a lot in your understanding of bond valuation. Then at the end of the chapter, they have got the concept of yield to maturity, which is section 4.5. And with a straight bond formula, we are solving for B0, i.e. the value or price of the bond. And when we talk about yield to maturity, we are solving for the required rate of return of the bond, where the price of the bond will be given. So if you look at these variables on the screen, we will be given BO, the value of the bond, at the particular date that we are assessing the bond. And that BO will be the price of the bond. So if there's bonds being offered in the market, they will say, okay, we're selling this bond for 2,305 Rand. Then we would then put that into the place in the formula for B0. Or if you were using the financial calculator, it would be the PV of the bond. We would be able to work out the PMT because we know what the nominal value and the coupon rate of the bond is. We would be able to work out N, how many years there are left to maturity of the bond. We would be given M, which is what is the nominal value of the bond. And then we are calculating R. We are solving for R in the bond formula. So again, just like at the end of Learning Unit 2, where they had that section that was alternative uses of present value formulas, where we then solved for PMT or we solved for R, etc. This is exactly what you're doing here. Okay, so when a question says calculate the yield to maturity of a bond, we're going to have all of these other inputs and solve for R. And if they say calculate the value or calculate the price of the bond, then we are going to solve for B0. And then you've got example 4.8 and those 3 questions that follow from question 4.6 to question 4.8 at the end as well, which will also help you to then practice all of those concepts. And then obviously you've got your revision questions at the end of the chapter as well. So guys, I think you'll be able to work through this chapter and your examples and questions using this information that I've given you. That should help you to understand exactly what you're doing in a bond calculation. Most important thing of all is that you practice and that you work through all examples and questions in the chapter. And then don't forget, we will have 2 sessions. The 2 sessions immediately before your task 2 is due, we will go over some real life questions, some past paper questions. We'll practice some of those as well. So between now and then, you should work through the chapter, learn the formulas, go through the examples, use the questions to practice and to make sure you understand everything. And as always, while you're doing that, if there's anything you don't understand or you've got questions with, or you want an explanation for, please let me know and I will help you. Okay, guys, we've come to 7 o'clock, so I'd better finish up in case anyone's got another class to go to. So thanks very much, Diana and Amita, and I know Kate Umetsu was with us for a short while. Thank you very much for your participation. And then I will chat to you guys next week. And next week on the 11th of September, we'll have a look at Learning Unit 5 share valuation.